Welcome to our module on advanced diagnostic methods in univariate time series analysis. We will cover sophisticated techniques for robust modeling, moving beyond standard approaches. All demonstrations will be implemented using Eviews, focusing on practical application. Our guiding principle is to let the data speak, but to ensure we're using the correct statistical tools to interpret it. For instance, simply looking at a stock price chart might suggest a clear upward trend, but advanced diagnostics might reveal it's actually a random walk, making long-term prediction impossible. This is the kind of mistake we want to avoid. To understand why these advanced methods are so crucial, let's first examine a fundamental problem that plagues time series analysis: spurious regressions. A common scenario in time series analysis is encountering high R-squared values and significant t-statistics, which might seem promising. However, these results can be entirely invalid, a phenomenon known as spurious regressions. This often occurs when regressing one non-stationary time series on another, making visual inspection highly deceptive, as seen in the contrasting graphs of a random walk and a trend stationary series with a break. Standard unit root tests, such as the augmented Dickey-Fuller test, frequently fail in the presence of structural breaks, like economic crises or policy shifts, or during explosive bubbles and speculative frenzies. To combat this, rigorous and objective statistical testing is crucial for stationarity, seasonality, structural breaks, and nonlinearity. Ignoring these aspects leads to invalid forecasts and misleading correlations, emphasizing why advanced diagnostic methods are essential. This decision map provides a strategy for analyzing time series data. We start with the raw data and ask a series of questions to guide us to the appropriate test. First, we assess if the series is trending. If it is, we use standard unit root tests. However, if we suspect a structural break, we must use a breakpoint unit root test. If the trend appears explosive, we should use bubble tests. Next, we consider more complex dynamics. If we suspect the series is a random walk, a variance ratio test is appropriate. If we're looking for nonlinear patterns or chaos, the BDS independence test is the tool to use. For analyzing cycles at different frequencies, we turn to wavelet analysis. A crucial rule of thumb is to always test for structural breaks if your series covers long historical horizons. The core of unit root testing revolves around this regression equation. The key is the coefficient gamma. If gamma is 0, the series has a unit root and is non-stationary. If gamma is less than 0, the series is stationary. The ADF augmented Dickey-Fuller test is a workhorse model. It's a parametric test that adds lagged difference terms, the sigma part of the equation, to handle serial correlation in the error terms. The PP Phillips-Perron test takes a different, non-parametric approach. Instead of adding lags, it adjusts the test statistic itself to correct for serial correlation and heteroskedasticity, making it robust to these issues. The KPSS test flips the logic. Its null hypothesis is that the series is stationary. This makes it a useful confirmatory tool alongside ADF or PP. If ADF fails to reject its null, unit root, and KPSS rejects its null, stationarity, you have strong evidence the series is non-stationary. If you test a stock price series and an ADF test gives a p-value of 0.50, you cannot reject the null hypothesis that gamma equals 0. This indicates the presence of a unit root, and you must difference the series to achieve stationarity before using it in a regression model. But as we've mentioned, these standard tests have a critical weakness. They can be fooled by structural breaks, which we'll explore next. Here's the twist. A time series that is actually stationary around a shifting trend can look like a non-stationary random walk to a standard ADF test. This is a major source of bias. Perrin's 1989 critique was groundbreaking. He showed that conventional unit root tests are biased toward non-rejection of the unit root null when a structural break is present. This means we might incorrectly difference a series that doesn't need it, a problem called over-differencing. Breakpoint unit root tests solve this problem. They explicitly allow for one or more shifts in the trend or intercept under the alternative hypothesis, giving a more accurate picture. These breaks can be modeled in two main ways. An innovation outlier, or IO, represents a gradual, dynamic change. An additive outlier, or AO, represents a sudden, instantaneous shock to the series. Explosive behavior is common in financial markets, such as cryptocurrency or housing markets during a frenzy. These are often called bubbles. Standard ADF tests are designed to test for a unit root, p equals 1, against a stationary alternative, p less than 1. This is a left-tailed test. Bubble tests, developed by Phillips, Shi, and Yu, PSY, are different. They test for a unit root against an explosive alternative, p greater than 1, making them right-tailed tests. The GSADF, Generalized Soup ADF test, is a powerful method for detecting and dating bubbles. It uses a rolling window approach, running the test repeatedly over expanding subsamples of the data. This rolling window method allows the test to identify not just the presence of a bubble, but also to date stamp its emergence and collapse with high precision. Panel unit root tests leverage multiple cross-sections to achieve higher power in detecting unit roots, especially with short time series, compared to univariate tests. However, a crucial assumption for first-generation panel unit root tests is cross-sectional independence, meaning that residuals across units are not correlated. If this assumption holds, you can use tests like Levin, Lin, and Chu, or LLC, which assumes a common unit root process across all cross-sections. Alternatively, Im, Pesseron, and Shin, or IPS, or Fisher-type tests allow the unit root process to vary across individual units while still assuming independence. It is important to note that these methods are only valid if the units, such as countries, are not economically linked, as dependence can lead to biased results. In reality, economic units are interconnected through trade, financial markets, and global shocks like oil price hikes or pandemics. Ignoring this cross-sectional dependence can severely distort test results, leading to false conclusions. The first step is to formally test for this dependence. The Pesseron 2004 CD test is the standard tool for this. It checks if the residuals from individual regressions are correlated across the different units in the panel. If the CD test rejects the null of independence, we must use second-generation panel unit root tests, which are designed to handle this dependence. The CPIPS test by Pesseron 2007 augments the standard IPS test by adding cross-sectional averages to proxy for unobserved common factors. Another advanced method, PANIC, panel analysis of non-stationarity in idiosyncratic and common components, decomposes the data into common and unit-specific parts before testing. Sometimes, a time series might appear to be random white noise. It has zero autocorrelation. However, it can still contain predictable nonlinear patterns. This is often seen in financial volatility, which tends to cluster. The variance ratio test is a simple way to test the random walk hypothesis. The logic is that for a true random walk, the variance of a Q-period return should be exactly Q times the variance of a one-period return. Deviations from this suggest predictability. The BDS, Brock, Deckert, and Shankman test is a more powerful portmanteau test for time-based dependence. It can detect subtle, nonlinear patterns and even chaotic behavior that other tests would miss. A key application of the BDS test is as a diagnostic tool. After fitting a model like a GARCH model to financial returns, you can apply the BDS test to the residuals. If the test is insignificant, it suggests your model has successfully captured all the linear and nonlinear dependence, and the remaining residuals are truly random. Wavelet analysis is a powerful tool that decomposes a time series into different timescale components, allowing us to view the data in both the time and frequency domains simultaneously. This perspective helps in separating high-frequency market microstructure noise from low-frequency macroeconomic trends. Its key applications include variance decomposition to understand whether volatility is short-term or long-term, thresholding for denoising by removing white noise to reveal the underlying signal, and outlier detection to identify anomalies at specific timescales. The discrete wavelet transform, using filters like Haar or Daubechies, is the primary tool for this analysis. Eviews provides a user-friendly graphical interface for all these tests. The central hub for univariate diagnostics is the View menu of a series object. To access the tests, you first double-click on a series to open its window. Then, you navigate to the View menu. Under unit root tests, you will find options for standard, breakpoint, and seasonal tests, as well as bubble tests. Under time series diagnostics, you'll find the variance ratio test and the BDS independence test. Wavelet analysis is also available directly from the main View menu. To run a breakpoint unit root test on a series called GDP, you would double-click GDP, then click View, Unit Root Tests, Breakpoint Unit Root, which opens the dialog box for test specifications. Let's put this into practice with a few real-world case studies, starting with macroeconomic data. In our first case, we analyze quarterly GDP data. A visual inspection shows a clear upward trend, but also a sharp drop around 2020, likely due to the COVID-19 pandemic. This suggests a potential structural break. We navigate in Eviews to View, then Unit Root Tests, and select Breakpoint Unit Root Test. In the settings, we specify the test for the level of the series with a trend and intercept. We choose an innovation outlier to model a gradual recovery and let Eviews find the break date that minimizes the Dickey-Fuller t-statistic. The test identifies a break in the first quarter of 2020 and finds that the series is trend stationary once this break is accounted for. The key takeaway is that GDP is not a random walk. For forecasting, we must include a dummy variable for 2020 Q1 to account for the structural shift. In this case, we examine the S&P 500 price-to-dividend ratio, a common valuation metric, to test for market bubbles. We navigate to View, Time Series Diagnostics, and then Bubble Tests. We select the Generalized SUP-ADF, or GSADF test, which is designed for this purpose. The interpretation is straightforward. The output chart shows the test statistic over time against a critical value. Whenever the test statistic exceeds the critical value, the null hypothesis of no bubble is rejected, confirming explosive behavior. The results clearly identify two periods of explosive behavior: the dot-com bubble around 2000 and the period leading up to the 2008 financial crisis. This confirms the presence of market irrationality during those times. The date stamping feature precisely identifies the start and end of these market bubbles. Here, we analyze gasoline demand for 18 OECD countries. Given that global oil prices affect all these countries, we must suspect cross-sectional dependence. The first and most important step is to run a cross-section dependence test. The result shows a p-value less than 0.05, which means we strongly reject the null of independence. This confirms that a global shock, like an oil price change, affects all countries in our panel. Because dependence is present, using a standard first-generation test like Levin-Lin-Chu would be incorrect. In fact, it gives a biased result, suggesting the series is non-stationary. Instead, we must use a second-generation test. We select the CPIPS test, which is designed for dependent panels. This test gives the valid result: gasoline demand is stationary. The standard test produced a false negative due to ignoring the common factor of global oil prices. In this final case, we analyze the JPY/USD real exchange rate, which is often very noisy. We utilize wavelet analysis to decompose the series. The first step in Eviews is to navigate to View, Wavelet Analysis, and select Variance Decomposition. Next, we apply a Daubechies filter of length 4 to process the data. Then we perform thresholding to remove the high-frequency coefficients, specifically D1 and D2, which represent short-term shocks and microstructure noise. The result is a reconstructed signal that clearly reveals the macro trend without any microstructure noise. This analysis indicates that the volatility is driven by these short-term shocks rather than long-term trends. The ultimate utility of this denoising process is to clean the data, thereby enabling better forecasting performance. While the Eviews graphical interface is convenient, using command syntax is far more efficient for reproducible research and for automating tests on many variables. For example, for a standard ADF unit root test with a trend and automatic lag selection using the SIC, the command is seriesname.uroot.adf trend info equals SIC. To run a breakpoint unit root test with the IO method and a break in the trend, you would use seriesname.breakuroot method equals IO, break equals trend. The GSADF bubble test is simply seriesname.bubble type equals GSADF. For a BDS test with an embedding dimension of 2, the command is seriesname.bds dim equals 2. To run the CIPS panel unit root test on a group object, you use groupname.uroot method equals CIPS. Finally, to perform a wavelet decomposition, the command is seriesname.wavelet type equals decomposition. Using commands allows you to script and automate these tests for hundreds of variables at once. For a full list of options and arguments, always consult the official Eviews command reference. To summarize, employing advanced diagnostics is crucial for preventing costly modeling errors. This presentation was developed by the econometrics group Viet Lod. You can find more